Okay. Hello, everyone. Very pleased you could join us today. My name is Olga Piłat, and I'm a researcher of IFI Global. Welcome to the launch of IFI Global's monthly magazine program, which we have called Vision. I'm here to operate technology and make sure that everything runs as it's supposed to. It means no hitches for us today. That being said, I'm now going to hand over to Simon, who is going to present for about 15 minutes.
Thank you, Olga. Yeah, we're absolutely delighted to have somebody who's got more technical ability than me operating this thing today. So we're delighted that she's there. And welcome to you all for the launch of our monthly magazine program. As Olga says, we've called it Vision. Each month, we are going to pick a deliberately different set of topics and perhaps be a little bit more controversial, provocative, and dare I say, honest than some of the other fund industry events, whether they be online or physical. Today, with me, I have Dr. Peter Cripwell, who's the CEO of Risk System, who I'm going to talk to about ESG's impact on risk management, which I think is going to be much bigger than most people at the moment currently suppose. And then we are going to move to John Christmas, who is going to give us an assessment of what is going on in Malta, which is still, or is, the EU's third largest fund jurisdiction. And just at the end, we might spend a couple of minutes changing subject to Latvia, of all places. John's going to be the subject of a television program in Latvia on corruption there. And he might have one or two interesting things to say on that particular subject. So today, as I say, we're going to cover, I'm going to talk for a few minutes now on the situation in the European Union, the relationship with the UK, and then we're going to completely change track to risk management and ESG, and then on to Malta and even conceivably Latvia. So as I say, deliberately very diverse set of things we're going to be talking about. As I say here, the EU-UK divergence is really just beginning. And the relevance of the vaccine and the fish wars that we've had over the first few months of this year is that they are emblematic, in my view, of underlying problems that are not, I'm afraid, going to go away anytime soon between the EU and the UK. I mean, who would have guessed? Just don't forget, the transition period only ended at the end of December. We only have been, UK has only been an independent country outside the EU for, what is it, 4 months or something, 4.5 months. And in that period of time, we have seen AstraZeneca factories raided in Belgium and Italy. We have seen the EU threaten to tear up contract law by imposing export bans on vaccine manufacturers. And the French just the other day threatened to cut off the electricity supply to Jersey. And that's not counting for a few hours back in January when the EU temporarily closed down the border in Ireland. None of this obviously augurs very well for future EU-UK relations, and clearly obviously reduces the chances of an agreement on financial services. And just yesterday, by chance, there was a headline in the Telegraph saying France seeks to keep the city out of Europe after fishing spat. So this is where we are, as I say, just a few months into the post-EU relationship that the UK has with this entity on the other side of the English Channel. There are only 3 possible outcomes from where we are. The first is that the UK eventually accepts who's boss in the European neighborhood, and that is the EU. We accept extraterritoriality in order to trade seamlessly and to travel unhindered and get, for example, a financial services agreement and doubtless many other agreements. So we accept basically the proximity issue that the EU has brought up many, many times in negotiations over the last few years. And we accept that we have to, for want of a better term, slightly kowtow to Brussels in terms of what we do because we're in the European region. The other possibility is that the EU accepts the UK's right, respects the UK's right to diverge, and we get unhindered trade across Europe. Things do bed down. There's a lot of hope that will be the case. It could happen. And we do get, for example, later this year, a financial services agreement, and doubtless many other agreements too. This is all a bit of a sort of rough edges stuff at the beginning of this new relationship, and things will bed down. That's the second possibility. And then the third possibility, which I have to confess is the one I think is the likeliest, is that there will not be one, or neither one nor two will actually really happen, and we will get something a bit like we had in Europe 2 centuries ago. I think Europe is increasingly resembling where we were 2 centuries ago, and we get to something like Napoleon and modern update of Napoleon's continental system, which means that the UK will turn away increasingly from the EU, trade unhindered with the rest of the world. Our Trade Secretary, Liz Truss, has been running around the world like a maniac, signing up free trade agreements everywhere. And quite quickly, and probably faster than most people predict, our trade patterns, this is UK, trade patterns, including in financial services, incidentally, and in the fund industry, will spread out across the world and will be less dependent upon the export markets of the EU. That would not be good for the EU because they sell us 100 billion euros more than we sell them, but that is perhaps where we are going today. Now, I just want to spend a second talking about Europe's or the EU's economic difficulties, which I don't think, at least if you're in the UK, get covered nearly enough. The first is the subject of the vaccine rollout. As you are doubtless well aware, it has had an impact upon economic forecasts. UK's economic forecasts have been revised upwards. We now have a consensus here that GDP for the year, even after being in recession for the first 3 months of the year, GDP for the full year of 2021 will be well over 7%. Because of our relative success on the vaccine rollout and the fact that hopefully things are getting back to normal right now. Unfortunately, as we all know, in continental Europe, that hasn't been, the vaccine rollout hasn't been quite successful. They are beginning to catch up now, but growth forecasts have been revised down and revised down again. That could cause problems, especially for France, with its very large amount of debt, and indeed in what are called the Club Med countries too. I think it's not very widely known that France has the 3rd largest debt level in absolute terms in the world. And unless it gets strong growth in the second half of the year and next year, that is only going to grow yet further. And I'll come to Italy in a minute. I do think it's worth mentioning what's going on in Karlsruhe, which is a small town in southwest Germany, which is the location for the German Constitutional Court. They have a case, I don't think they've started hearing it yet because it was only filed relatively recently, which claims that the ECB has breached Article 123 of the Lisbon Treaty in its QE program. And without doubt, I think most people would agree it has breached Article 123 because it is, as the complaint alleges, EU debt mutualization via the back door. I mean, what has been going on in QE in Europe, which is keeping the European Union going, is quite extraordinary and very underreported in this country. It's an amazing statistic that the ECB's balance sheet is now at 71% of GDP. That's double the size of the Fed, the US Fed's balance sheet. And that's because of all the buying up of debt across the EU, but particularly in Southern Europe. Now, the German Constitutional Court, according to an expert, Wolfgang Monschau, who runs Euro Intelligence and who follows these things very closely, his view is that the court does not want to upset the apple cart, but it understands this is not what the Lisbon Treaty, it doesn't want to have German taxpayers underwriting debt guarantees across Europe. So it's in a really tricky position. Last year, as you may know, the court fired shot across the bows, calling the QE program to account, and no notice has been taken by Christine Lagarde and the ECB of that. So it'll be very, very, very interesting to see what they come up with this time. Again, according to Wolfgang Manschau, they are generally very, very pro-European. They're not interested in wrecking the EU. On the other hand, they are in a very tricky situation from a legal point of view. So that is one to watch. We have no idea when that ruling will come to be. Finally, as I say on this slide, EU fiscal coordination is close to certain to be happening in the next couple of years. I think almost everyone would agree you can't have a currency across however many countries are in the Eurozone without a level of fiscal coordination. It simply isn't working at all. That may well then mean that countries such as Ireland will have to lose their corporation tax rate, which is currently 12.5%. So I said I'd come on to Italy, and I would like to do that now. Again, I don't think many people have a real idea of the extent of the problems that there are in Italy. In December last year, a senior aide to the Prime Minister Giuseppe Conte, who's very pro-Europe, he went to the ECB and he asked permission to see if the Italians could have a repayment holiday of their debt. He was told there was absolutely no chance that was going to happen because their debt really is getting to unmanageable levels, even with all the QE that has been going on in support of the Italian economy. You might be interested to know, if you don't already know it, Italian debt currently stands at about 161% of GDP, and its budget deficit is approximately 12% of GDP. If things do not improve quickly in Italy, we could be looking at the EU imposing a troika type regime on it, as it did in Greece. But of course, Italy is a much larger economy than Greece, and how the Italians react to that is something that we won't get into today, and let's hope it never comes to pass in the first place. But it is one to watch. And by the way, if the Italians were to default on their debt, that would be a systemic crisis across the EU, particularly in France. The French banks are very heavily exposed to Italian debt, and one wonders if there was a banking crisis in France as a result, which could well happen, whether the EU, having watched what they did with the vaccines and the raiding of the AstraZeneca factories and the denial of exports, whether they would consider imposing capital controls upon the Eurozone region. Very extreme, probably not going to happen, just worth mentioning in passing to ponder, given the way that things have been going over the last few months. Quickly onto the German federal election, which, as you doubtless all know, is in September this year. As she's called in Germany, Mutti Merkel is going. And if you look at the opinion polls, in preparation for this event today, I did look at the latest opinion polls in Germany. The Greens are in the lead in the opinion polls in Germany. But more important than that is that it doesn't look at the moment, things could obviously change, it's still a good few months away, but it doesn't look at the moment, if the current polls were to be reflected in votes, that there could be a stable coalition formed after the German federal election. And that could have knock-on effects in Europe as well. But even if there is a stable coalition, bear in mind that Mutti Merkel will not be there. Who will be the de facto leader of Europe? Could it be President Macron, which he would dearly love to be? That is something to bear in mind. And just in passing, one of the reasons why, if whatever happens in terms of the vote, the Greens are going to do very well. Clearly, currently on 26% in the polls, they're almost certainly going to get well above 20% in the polls, which makes it difficult to form a coalition without them. And that brings up the issue of the pipeline from Russia, the natural gas pipeline from Russia to Germany, which the Greens are against. Most other people in Germany are in favor of. And that's one of the reasons why it could be difficult to form a coalition. could be a very interesting autumn, politically speaking, in Germany. Finally, the EU's economic performance at the moment appears to be going from bad to worse. There was there were a mild recession in the first quarter. Given the pandemic, it could have been a lot worse, but the chances of a V-shaped recovery occurring in continental Europe in the second half of this year are not good. That looks like happening both in the UK and the US. The danger in the UK and the US, of course, is the inflationary threat that is now everyone's talking about here and in the US. But they certainly don't have to worry about inflation in continental Europe. But they are struggling, clearly. It's worth making the point in passing that the German GDP was down 1.7% in the first quarter. And as to quote Wolfgang Muncher, who's an expert in all these things, he keeps saying this, he's been saying this for years, the German economy is not well equipped to deal with the 21st century. It is obviously at the moment, the economic engine of Europe. If the German economic situation does not improve, who is going to take up where is the growth going to come from in Europe? It is worth making that point in passing, especially because European social security spending globally is just under half of the entire world's social security spending, but Europe has less than 10% of the world's population. That cannot go on forever. So those are my opening thoughts in the first of these magazine programs. I'm now going to stop sharing screen. We're going to have a completely different change of subject. I'm going to make Olga the host, yep. And then we are going to bring Peter in. So there you go, Olga. Hopefully you are now the host. Hopefully you quitted that properly. And we're going to completely change pace from what's going on in continental Europe and the relationship of the UK with it to a subject, as I said in my opening comments, is not nearly well known enough yet, is the impact of ESG on risk management. And we have there he is, Peter, who's the CEO of Risk Systems. Welcome to IFI Global Vision, Peter. Let me start by asking you this particular question. Where, in broad terms, what do you think the impact of ESG is going to be on risk management?
Good afternoon, Simon. Good afternoon, everybody. I think we're currently in the foothills of where this is going to lead, but I think the impact of ESG and the implications of actually adding it into the overall sort of toolbox of things that have to be worried about is going to be extremely profound. I think you need to look at this in terms of we are now effectively getting a new dimension of data and basically adding some colors that we haven't seen before. And to ruin the metaphor even more, we don't really know what those colors look like, and the glasses that we're using have quite a few blind spots. So it's going to, and so we have a data issue at the moment, which is quite profound. But further on, it's how is this going to be applied in the risk management space? And I think there's going to be a very large amount of development work here, both from the regulatory side, but also, without a shadow of doubt, from the fund side, due to the fact that, you know, you can add ESG onto a fund's name and it seems to do extremely well ex post, but then you're going to have to make certain that you're not greenwashing or you're not slipping in and out of where you want to be. That is a risk management problem, and it's going to have to be addressed.
Yeah, I'm glad you brought up greenwashing, as we discussed in our prep call. How can the industry overcome the greenwashing problem? And there are potential legal difficulties. People could be sued and all the other stuff, as we discussed yesterday. How can that problem be overcome, do you think?
Well, I think firstly, the taxonomy and the KPIs as described in the SFDR documentation and the legislation you know, it's the standardization of what it means to be ESG. Is, I think, firstly, you've got to realize, well, what are we talking about? And we all have to agree on what we're talking about. So I think that's a great step forward. But I think equally, then it has to be taken down to product level. So in other words, you've got to make certain that whatever you're doing isn't able to be effectively gamed by the system. So, for example, in the guidance, it says, well, we will have CFDs, contract for differences, are going to be included in the taxonomy, but they don't mention things like total return swaps, which are effectively the same thing, but not the same name. It's these sort of areas where you're going to have to put in a lot of effort to make certain that what you're actually doing is both consistent with the letter of the legislation, which is obviously the course of the regulators, but also, I think, and it's going to come a lot more, the spirit of the legislation, because, you know, you said yourself in your original talk, the Greens are going to be the largest party in the German parliament. Now, this being the case, they're not going to take kindly to people starting messing with their green agenda through the funds industry. So I think you need to think about this in a much broader way than just the narrow vision of, well, we'll tick a box here and move on.
Yeah, you mentioned when we spoke before this today that there might be a need for an ESG VAR. How on earth would that work?
Oh, to be honest, it's a logical extension. You have KPIs now, that's a number. So now you've got to worry about, okay, well, what happens if the regulators say, well, you can do an SRRI, so in other words, what's your volatility? Well, I'd actually like to see in your key investor information document, what's your, you know, what is your ESG-ness, as it were? In other words, how ESG is your fund? At that point, you've got to worry about, well, if I'm in a certain box today, how likely am I going to be in that box next week or next month? And now you've got to start worrying about, and this is again part of the data issue, we don't actually have a very good feel for how variable is the ESG-ness of an ESG portfolio. This is where we're going to have to backfit things. We're going to have to actually look far more deeply into the actual ESG and the sensitivity of the ESG-ness, as it were, of a portfolio to the underlying investments, to the evolving markets. I mean, you know, there's a large amount, you know, people say, oh, well, we can measure rotation in and out of various industries. Well, ESG is like that, but you've sort of added a vast amount of complexity into it. And if funds are worried about dropping out of their ESG bucket, well, I'm afraid they're going to have to monitor their sensitivity. And this is getting you down the route of, what is your ESG VAR or ESGAR or whatever the heck it's called?
Well, who on earth can make the rules for this? Because we'll come on to the SFDR in a second, but the SFDR is continental Europe's answer, but most fund managers are not headquartered in continental Europe. They're headquartered in the US or the UK. And the US, by the way, quite astonishing speed since Biden became president, is catching up very quickly indeed. So, but the US is going to do its thing. The UK with the TCFD is going to do its thing. Continental Europe is doing its thing. How on earth are we going to get some sort of agreement on the parameters for this? And there's plenty of competitors who measure all these things, the MSCIs, the S&Ps of this world, the Refinitives of this world. You know, there isn't an industry standard. So what's going to happen?
Well, again, I think this is going to be, you know, I would be less, what's the word? I'd be less concerned about the standardization. I think the SFDR will drive standardization in the same way as GDPR has driven standardization in the privacy area. I think once you actually go as far as, say, put things down in legislation, there's a sort of pull effect. And I appreciate the US is different, but they'll look at it and they'll come up with something very similar. I appreciate the FCA can do whatever it likes, but I think it's very interesting in their sort of roadmap for the future. The first thing in the list of things they're going to worry about is going to be ESG. This is just not going to go away. I think it's going to happen that you're going to have the KPIs which the European Union are looking at. They're going to be mapping quite closely. It's not that there's a million ways to skin the whole cat. What we need to understand is how this data moves around. And I don't think this is going to be, I think understanding the data is difficult. And I do appreciate that very many different people will have very many different viewpoints, but that's more a matter about the fact that we haven't actually had the information beforehand. So you've had different firms deciding to do things different ways. As you have the KPIs and as we actually get more data, basically the systems that actually can't map properly onto the data that exists, well, they'll be of less value to people and people will move. It's actually in the data providers' interests to actually not be, to actually try and make certain that the analysis and the type of things that they do map appropriately onto what is required by regulators and investors. I see this as being fairly market driven and regulator driven, getting us to won't be exactly a single point. It's not like everyone does VAR the same way, but there will be a consistent overreaching principle into how this is done.
Can I ask you, we've touched upon a couple of times the SFDR. You expect or think that something similar will be adopted in the US and the UK, or perhaps in the coming years. When I look at the SFDR, as we all know, the first level of it came in on the 10th of March. We're waiting for the final word on the really difficult bit, which we expect will be announced very shortly, and it will probably be the beginning of January next year. Apparently that's what ESMA wants. When I look at it from the outside, when I hear comments from the experts, which would include your good self, it looks horrendous. On top of all the other things that the poor European fund industry has to deal with in terms of its regulatory burden, it's got this monster coming down the line. It's the level 2. The level 1 hasn't been a problem at all, I understand, but the level 2 looks monstrous. Is that correct?
Well, it certainly looks monstrous. It does. I mean, I would say at this distance, it could be very, very tricky when it is first implemented. And by tricky, I mean, the data itself is not clear. We still haven't actually had the delegated acts out of the European Parliament, so we still actually don't have full definition. On top of that, the information required to do KPIs is by no way complete, and our ability to work out how we put KPIs onto things that aren't easily covered in the current set of guidance is again going to be challenging. It's one of the reasons why at Risk System we have decided, we've been looking at this for the past 6 months, and we're working with Ideal Ratings to actually have a better idea of what ESG data looks like, because the biggest thing is, if you're not actually looking at data at the moment, you are going to struggle. It may be in January if they get the guidance out in June, but you need to be considering what's happening now. If you start working now on how this is going to work, you should be in an okay position come January. However, if you decide, in December to start looking at it, yeah, it could get very, very tricky, because in reality, we're going to be learning as we go along. And if, the sooner you start your education, the more likely you are to pass the exam in January.
You say, you've got to start working on it now, but there's all sorts of other regulations coming along. There's distribution directives. There's also, there's an armful of things. There's AIFMD2. There's this, there's that, and the other. These people, everyone's stressed out with all the stuff that's coming. When people don't have the time for this.
Well, again, you see, I think this is the advantage of, a delegated model means this is something that people have to be looking at, but it doesn't have to, what needs to happen is that fund managers need to understand that there is somebody actually on this case. If the fund manager or if the Manco manager is actually doing the work now, then yeah, that could be an issue. But what you need to make certain is that you are actually putting infrastructure in place so that when push comes to shove, it's not going to be a nightmare. I'm not saying to you that, every UCITS in the world has got to actually start spending valuable time of the manager or of the administrator trying to deal with this. What I am saying is that you have to actually start putting in place a plan to make certain that when this becomes critical, you don't actually have to run around like a headless chicken, which if you're not actually start thinking about it now, the headless chicken scenario could come in.
Finally, I'd like to sort of quickly touch upon the fact that, as we just discussed the other day, there's been very little guidance so far from ESMA on all of this. And also what would happen in the sort of worst case scenario if there's all this sort of monster, if you want to call it that, of the SFDR goes forward, funds start breaching their ESG risk limits. Are we going to look at, and the fund doesn't perform well, are we looking at a whole set of funds being sued by investors in the future? Could that happen?
Well, I think that, to be honest, it's sort of, you know, I don't honestly think the regulators are going to come in with a big bat to beat everyone around the head. They, like pretty much everyone else in this sector, are actually learning as we go along. And I don't think it's reasonable to think that they're going to sort of, you know, play, you know, absolutely smack people. But I think there's a complete separateness between that and the actual eco warriors, or the sort of the more affluent eco warriors who are actually buying these products. They are clearly buying them because of the fact that there is a sort of a transferred psychic good about them, and they want to save the planet. And if you've, I mean, you have to be honest about this. It's sort of, you know, it is what is driving the huge growth about this. They want to save the planet, and if they find out that you are not saving the planet in line with what you've told them, they are likely to get somewhat litigious somewhat quickly. And because of the fact that we are now, you know, the latest guidance showed you the template that you have to fill out. This is going to be easily accessed information. And if you've got the wrong numbers in it, and they've actually, and you've told people that you're doing everything perfect, yeah, this could get very tricky for all parts of the actual food chain, because this is not something where you want to actually tell people we're saving the planet purposely by buying vast amounts of arms manufacturers and oil. That is going to be an issue.
Fascinating, absolutely a subject I'm certain we're going to be coming back to many, many, many times in the future. I think it's just sort of the first of many discussions on this. I can see a whole range of topics for us to get stuck into in our various publications. Peter, thank you very much indeed. I'm going to ask Olga to pop back up and ask you to go back to the audience, and we're going to bring in John from Malta. Let's hopefully the technology works. Thank God I'm not doing it, because it wouldn't if it was me operating it. So hopefully see you soon, Peter. And
yeah,
hopefully we'll see you.
Thank you.
I have to make you an attendee, so thank you.
Bye.
Bye. And John, Christmas. Yeah, I think it's going well.
Let's hope the Latvian mafia haven't got him since we last spoke to him a few minutes ago.
I think we're lucky this time. Yeah.
Okay.
Yes. Right. Okay. It should work now.
As we're bringing John up, and let me do the introduction to save time. John, hopefully you can hear. Oh, there you are. Hi, yeah. Nice to see you. Don't forget to turn your mic on, John. You're muted at the moment. Yeah, I just wanted to say, as we discussed the other day, I went down to Malta around about, I think it's around about 2004. I was incredibly optimistic about the future of Malta. I really thought this place was really going to take off and was going to break the duopoly, the Dublin Lux duopoly. There were people I met were fabulous. The place was stunning. I was probably about the time it was May. It was a beautiful day or a couple of days. And I really thought everything was going to go right for Malta, and it was really going to become the third international European fund jurisdiction. I just looked before this call. I think this figure is maybe very slightly out of date, but I think the assets of Maltese funds at the moment is something in like 16.16 billion euros. Meanwhile, Ireland's got something in the region of 3 trillion euros. And Luxembourg's got 4.5 trillion euros. So it hasn't exactly gone according to plan. Why do you think that is, John?
Well, we're still here, and I still think that I'm confident that Malta has a more competitive offering in cost in particular compared with Ireland or Luxembourg to serve as a fund domicile. I got into this business 2013 is when I set up a directors group in Malta, and we had high hopes that there would be more and more funds and also more and more asset managers domiciled here. And we do have the legislative and regulatory framework for that. I mean, more competitive than the other countries. And we do have all the professionals here to service the industry. What Malta went through, in a nutshell, is a big corruption scam, which tarnished the reputation of the country right at a critical moment with Brexit, and a lot of people were picking an EU country to be their domicile. Even though Ireland and Luxembourg cost more, that Malta was not considered serious because there were a few years with the headlines of investigative journalist Daphne Caruana Galizia getting assassinated, and some corruption that went to the top of the government. There were some years where people were afraid to come here or afraid to set up a business here. Although by now, the government has changed. There are people getting prosecuted. There are people in jail already. The leadership now is not the same as it was. And throughout all of this, we've always had business-friendly legislation, and I believe there's some real integrity in this country. And I mean, I'm proud with what the people did, for example, to change the government. And I think it's a great domicile.
Yeah, I mean, it's, as you say, the legislation's been in place for a long time. The MFSA has been noted for a long time as being very proactive, and sort of he's got sort of heroic status not only in Malta but around Europe. Professor Bannister, now retired, who ran that for so many years or decades. And the legislation was good, the MFSA was good, and as you say, all the building blocks were put in place quite a long time ago now, but it just hasn't taken off. You think it's the corruption, the murder of the journalist you just referred to, and the sort of the reputation that Malta's had has been the biggest stumbling block to that?
Well, something I can say is that the person right now who's the acting CEO of the MFSA, they changed the structure. So it's not, Professor Bannister was chairman, but the guy now is CEO. His name is Chris Buttigieg. I know him well. I've met him many times, and I have a high opinion of him for integrity, intelligence, honesty, and so forth. The government throughout, actually even during these corruption scams, has always been pro-business in the sense of fighting the European Union on certain things, like that we're not going to raise our taxes and raise our minimum wage, and that we're when we receive the EU directives, we implement them, but we implement them wherever there's leeway to make them as business friendly as possible. We've always been doing this. Yeah, the headlines about the journalist, I mean, not the headlines themselves, because obviously things like this should be in the news and should be in the media. And if you have temporarily have a corrupt prime minister, it should be in the news. But anyway, this, I believe Malta has shown itself resilient, that, you know, there was this very popular politician who kind of won the hearts of a lot of voters, and he didn't really deserve that. And other countries have fallen under this before as well. I think that we have a great offering here. And the thing that I've mentioned to you previously is, for example, when you compare us with Ireland or Luxembourg, quite a bit of the fund servicing work actually gets outsourced to here. The administrators, for example, which are present in all three countries, if you hire them in Ireland or in Luxembourg, you actually get the same people working on your account, except they just jack up the fee if you're in one of those countries, because the people here pay less.
Yeah, you mentioned that. It's a very interesting point that probably not widely known, that how much of the real true back office is actually done in Malta, because it's a little bit cheaper than being in Ireland or Luxembourg. The other thing to be said for Malta, and this happened, I'm not sure whether it's developed much further since I last looked at it, but certainly there were a number of managers, particularly hedge fund managers, that put their own offices into Malta to do their own work.
Oh, well, for managers, the offering, I think, is great. I mean, I live here. I've been living here for more than 10 years, and I love it. I've got kids in the school system. I know about the school system. I know about the cost of living here. I live in a great apartment by the sea. The kids go to private school. I eat at restaurants whenever I want. I mean, on the same budget, living in Luxembourg or Dublin is not as advantageous. I also have great weather all the year. There are a lot of advantages to being based here. And then there's these tax things, like for an asset management company, if you set it up correctly, there's this full imputation system, they call it, whereby this is compliant with Brussels, whereby if your ownership is in a certain way and you pay out the profits and dividends, then you get most of the corporate income tax refunded. So the headline corporate income tax rate is not high. It's not zero, but anyway, what you pay is mostly refunded back to you. For individuals, for investors living here, the tax burden is low. Compared to, let's say, retiring to Spain or something, if you move down here, you get the same weather and you get less of a tax burden. So that's something for sure.
Okay, that's great. Thank you. And I said if we had a few minutes remaining, we only have a very short few minutes remaining. But just in case the Latvian mafia get you before we next speak, can you just quickly tell us all why you are going to be the subject of a television program in Latvia about corruption there? And since I started off with my sort of criticism of the EU, the person responsible for the EU economy as commissioner is a Latvian called Vladis. I'm going to massively mispronounce his last name.
I can say it if you want.
Thank you. But you think he's a little bit corrupt too, and perhaps you could explain this corruption situation that you're involved in as whistleblower.
Well, this touches on a few of the topics that you mentioned, such as the European Central Bank buying bonds from countries that it probably shouldn't buy the bonds, and it even touches on the greenwashing. I'll tie it in with Peter's concern about greenwashing. Essentially, I was in Latvia. I was employed by the largest bank in Latvia. I learned from internal meetings that the bank was fraudulent, and I reported this to government authorities. The result was that I got chased out of the country with threats, and the government loaned billions of euros to this bank. And then because there was a riot and people actually feared, I mean, my old office was destroyed in a riot. People feared that the Russian mafia had stolen the assets from the bank because that was the reputation of the bank. And Valdis Dombrovskis, who was the prime minister, called in the European Bank for Reconstruction and Development, which is located in London, and calmed down people by selling a stake in the bank to the EBRD, saying that this proves that the bank has not been looted. Now, it turned out later that the bank had been looted and my whistleblowing was correct. And it also turned out that the privatization was fake, that there was a secret reversion in the privatization that reversed it back afterward at even more losses to the taxpayers. Now, for some reason, either because journalists are scared or people don't understand accounting, this has been impossible to get into the media. So the mainstream media audience reads about Valdis Dombrovskis, who is now executive vice president of the European Commission. This is never mentioned. They make it sound like he rescued Latvia and he's a hero, but they don't mention that he signed a privatization that got secretly reversed and he caused Latvia to lose money. And this bank that he did this for was connected with Russian organized crime, and this is not mentioned. The EBRD then, you can go look at their website if you want to see greenwashing, puts out this nonstop flood of propaganda about how they're working on equality and fighting global warming, and they're even fighting COVID-19 now. I mean, they say that they're like the biggest heroes in the world and that they make a profit at the same time. Well, on this deal, they certainly made a profit, but it was an illegal deal and it wasn't anything green. It was organized crime.
Fascinating. Well, what a great start to our first ever monthly vision. Thank you very much. We'll have to have you back. Stay safe, John, because Malta, as you said yourself, has been the odd sort of killing in the streets where you are. So you don't want, be careful with Latvians wandering around, particularly when your TV program comes out. Hopefully you'll be around later this year and we'll have you back for another of these monthly vision programs. Thank you all very much for following this. As I say, this is the start of something new. It's unashamedly copied on The Spectator's absolutely excellent weekly magazine program called Spectator TV. This is an adaptation of what they do for the fund industry, where every month we'll have a different bunch of guests talking about whatever it is they'll be talking about. So thank you all for joining us. Have a nice lunch if you're here in Europe, and breakfast if you're in the States. and see you the next time. Goodbye, everybody.
Thank you, Simon.